You're tuning into the channel, and truly, you'll want to absorb every detail of this report. This is the moment. After an exhaustive period of waiting, years of persistent theorizing, and a constant barrage of late-night speculation, the financial culmination that millions worldwide had once deemed an impossible fantasy has now solidified into concrete fact. Global currency investors are reeling from the news. Markets are exhibiting extreme volatility, and as of this very morning, Saturday, November 8, 2025, the Vietnamese Dong (VND) and the Iraqi Dinar (IQD) are actively trading on the international forex platform. That is a confirmed reality. Two of the most closely watched currencies in recent memory have been formally restored, and financial institutions across the globe are currently in a state of urgent operational scramble to integrate the monumental shift. Trading screens across major centers, Dubai, London, and New York, are ablaze with intense activity, prompting financial analysts to definitively label this the forex resynchronization of 2025. In this comprehensive report, we will meticulously analyze the gravity of this occurrence, detail its profound implications for the average investor, and examine precisely why this one event is poised to permanently redraw the map of global money. Hold tight until the very conclusion, as the strategic details emerging from high-level, confidential discussions are nothing short of astounding. The initial indicators of this shift appeared with an unusual subtlety, almost too discreetly for the global financial community to notice. Near 3 a.m. GMT, London-based currency traders began observing anomalous movements on their dedicated trading screens. Uncharacteristic and sharp spikes in liquidity were being flagged within minor currency pairings that were specifically linked to Vietnam and Iraq. Initially, the reports were met with outright disbelief and dismissal. The IQD USD currency pair briefly materialized for only a few fleeting seconds before vanishing entirely. It then abruptly reappeared, and moments later, the VND USD ticker followed suit. A frantic cascade of calls instantly overwhelmed trading desks and banking centers. Analysts demanded immediate answers. Could this be a genuine system fault, a clandestine internal test, or was a truly historic financial activation underway? By 4:15 a.m., the confirmation was undeniable and absolute. The Central Bank of Iraq, CBI, had completed the formal public reinstatement of the dinar across all prominent international forex trading platforms. Vietnam swiftly followed, joining the system within the subsequent hour. Across the international financial landscape, the initial shock gave way to a wave of overwhelming validation and disbelief. For multiple decades, highly respected financial authorities had universally rejected the idea that both Iraq and Vietnam could ever successfully return their currencies to a global, tradable status. Yet here was the tangible, irrefutable evidence, visible in real time on every major forex terminal. Senior banking executives in Singapore and London immediately organized emergency coordination calls. In Washington, D.C., low-profile but crucial meetings began between the U.S. Treasury Department and the International Monetary Fund, IMF. The atmosphere across trading floors instantaneously converted from cautious curiosity to intense, focused adrenaline. The rates were demonstrably live. The dinar was registering an initial value near 391 against the US dollar, with the dong stabilizing just below 0.47. These specific, unprecedented numbers triggered a tsunami of financial activity across every connected global center. This event marks the first time in modern economic history that two long-dormant currencies have been successfully revitalized within hours of each other. Within mere minutes following the activation, social media platforms erupted in celebration. Hashtags such as #VND Reset, IQD Live Rate, and our Forex Shock 2025 were rapidly trending worldwide. Online investment groups that had existed in quiet dormancy for years suddenly overflowed with intense, jubilant excitement. Long-term investors in both currencies, individuals who had maintained their unwavering conviction for decades that this moment would occur, were now enthusiastically sharing live rate screenshots, ticker updates, and deeply emotional personal declarations. On social platforms like X, formerly Twitter, traders operating out of Zurich, Dubai, and Singapore confirmed the completion of successful live currency conversions. Some even posted verified bank receipts showcasing IQD and VND trades successfully settling and clearing in real time. The digital financial sphere was ablaze with activity, and critically this time the information was not based on speculation. It was a verifiable, unfolding reality. In Baghdad, the subsequent wave of public celebration was unlike anything witnessed in recent memory. As the news rapidly circulated across national television and social media, thousands of citizens immediately converged on local bank branches. People were seen openly holding their old dinar banknotes, an emotional mix of crying, cheering, and celebrating in the streets. "We stubbornly waited for 20 years for this day to arrive," declared one man outside a primary banking location in the capital. "They promised us our currency would eventually gain strength. And today, it has happened." Inside the central bank, officials released a brief yet profoundly significant formal statement declaring Iraq's complete and immediate reintegration into global markets. They proclaimed it a day when financial sovereignty was entirely restored. For the Iraqi populace, the success of this outcome transcended mere economics. It represented the reaffirmation of national pride and resilience. Meanwhile, on the opposite side of the globe, Vietnam was undergoing its own concurrent wave of economic transformation. In Hanoi and Ho Chi Minh City, bank branches initiated operations ahead of their scheduled time to effectively manage the large influx of citizens. The State Bank of Vietnam formally confirmed that the dong had been officially reinstated, and its value adjusted through meticulous and ongoing coordination with major international financial partners. Government spokespersons publicly hailed the event as a historic restoration of Vietnam's intrinsic economic value. Citizens formed patient, yet excited lines, successfully exchanging their older banknotes for the new, internationally recognized currency. The government guaranteed absolute financial stability, firmly assuring the nation that every single bank account, savings deposit, and pending transaction was completely secure and protected. However, hidden beneath the layer of public excitement, a vast, intricately complex financial operation was actively being executed, an endeavor that few outside the top echelons of global banking had any idea existed. For years leading up to this event, major international banks had been engaging in secretive preparation. According to multiple internal sources, key elite financial institutions and the IMF were operating under a confidential framework known as Project Phoenix. This highly specialized operation, created specifically to manage the seamless transition of dormant currencies back to active trading, was designed with the primary objective of preventing systemic financial instability. When the trigger was finally pulled, the existence of this once-rumored project was confirmed as factual, and it was immediately deployed the very instant the VND and IQD went live. Inside all major institutions, including HSBC, Chase, and Deutsche Bank, pre-configured automated security and trading systems instantly engaged. These highly sophisticated protocols rapidly balanced market liquidity, updated all required currency pair indices, and actively stabilized all forex trading corridors to prevent wild, chaotic fluctuations. For market traders intently observing the charts, the sudden, unexpected market stability appeared to be a genuine miracle. In reality, it was the calculated culmination of decades of rigorous, coordinated planning executed with flawless timing. As one highly respected veteran analyst observed, "The world has literally been preparing for this day without fully realizing the immense scope of the preparation." Global markets reacted with immediate and intense activity. The London Stock Exchange, LSE, opened trading with a significant surge across all banking and energy sectors specifically tied to Iraqi interests. In Tokyo, major Vietnamese manufacturing stock indices rose by nearly 20% in the overnight trading session. Prices for global commodities like gold and crude oil began fluctuating sharply as traders worldwide urgently recalculated global value chains based on the new currency reality. The US dollar, while maintaining its position of strength, showed a minor softening as institutional investors quickly diversified their holdings. Financial analysts were quick to label this as the definite dawn of a multipolar currency era, where financial influence is no longer monopolized by a single currency, but is instead dispersed across a balanced, interconnected network of global economic powers. In Washington, D.C., unverified but persistent reports indicated that Treasury officials held urgent, closed-door consultations with IMF representatives to collaboratively manage the sensitive public communication strategy. Their immediate objective was to maintain absolute composure in the market while simultaneously acknowledging the profound and undeniable reality that the entire global financial structure had been permanently altered. They are meticulously controlling the narrative and public perception, stated one policy insider. They are desperate to prevent any market panic. They need this immense transition to feel like a natural, logical progression, despite its magnitude as the most significant monetary event in generations. Across Europe and Asia, central banks released meticulously measured, almost identical public statements, urging both caution and patience while officially validating the live trading data. The shock was certainly not contained solely to financial professionals. Across the globe, countless ordinary holders of the Vietnamese dong and Iraqi dinar were waking up to life-altering financial news. For numerous years, these individuals faced constant mockery, were labeled as speculators or conspiracy theorists, and were frequently told their investment holdings were completely worthless. Today, they achieved spectacular vindication. Social media feeds were immediately flooded with emotional posts, photos of old, framed banknotes placed prominently next to family portraits, and heartfelt messages expressing joy, gratitude, and profound disbelief. Everyone found it hilarious, wrote one user, but I held firmly to my belief. Today, that banknote is the foundation of my future. For millions, this successful outcome was far more than mere financial profit. It was a powerful, symbolic statement of enduring faith finally being rewarded. Within the United States, several private currency exchange centers reportedly commenced operational activities under extremely stringent security protocols. Select individuals identified as pre-approved private clients were discreetly invited to begin redeeming their substantial currency holdings through highly specialized exchange procedures. Some insider accounts suggested that stringent non-disclosure agreements, NDAs, were required, while others alluded to a complex system of preset, tiered rate structures. While these precise details remain officially unverified, the undeniable movement itself was real, and the world's most significant financial institutions were actively facilitating the event. The entire Forex community accurately summarized the situation as controlled chaos, the distinct kind that only occurs when a turning point in world history is actively being written. As the sun began its gradual ascent, across the European continent, the IMF issued a definitive, yet brief formal statement, confirming the already clear reality. Both Vietnam and Iraq had successfully completed their international reinstatements and had fully satisfied all required structural compliance standards. The message was delivered without ambiguity. This was not a temporary systemic anomaly. It was official, lasting policy. The IMF specifically lauded the event as having monumental global significance, marking the successful and full reintegration of two major emerging market currencies. Beneath the polished, diplomatic language lay one critical truth. The core world financial order had fundamentally and irreversibly shifted overnight. Traders operating in Dubai confirmed the successful completion of live currency conversions between USD, IQD, and VND. In Zurich, private bankers fielded a non-stop barrage of urgent inquiries from demanding clients seeking immediate rate verification. In Singapore and Hong Kong, Forex trading desks were operating continuously around the clock. It was no longer business as usual. Every single hedge fund manager, financial analyst, and market trader was compelled to instantly adapt to a radically new financial reality. "It feels like the financial dam has finally and completely burst," commented one veteran trader. "Everything we previously assumed about trade balances and liquidity is now being instantly rewritten." However, even amid the intense global market excitement, a number of economic experts strongly urged significant caution. The sudden substantial appreciation of these currencies, especially the dinar's rapid rise, could potentially cause temporary regional disruption to trade balances. Existing import and export contracts would necessitate urgent and complex adjustment. Despite this, the prevailing consensus among experts suggests that this short-term market turbulence will ultimately lead to a more profound, long-term global financial equilibrium. This fundamental change is widely seen as ushering in a fairer world system, one where intrinsic currency value is determined by real national productivity, Vietnam's vast manufacturing capacity, and Iraq's immense oil wealth, rather than mere market speculation. The currencies now accurately reflect the true, underlying economic strength of their respective nations. Back in Iraq, The government formally declared Saturday, November 8, 2025, a national day of unity and celebration. Prime Minister Mohammed Shia al-Sudani addressed the entire nation in a powerfully emotional, televised broadcast proclaiming, "The Iraqi Dinar stands once more as the most powerful, enduring symbol of our stability, our sovereignty, and our rightful and permanent place in the global economy." Crowds in Basra and Baghdad erupted into thunderous cheers. Fireworks illuminated the evening sky. Citizens sang national songs, proudly waved their flags, and held their dinar notes high in the air. This outcome was far more than a financial victory. It was the symbolic rebirth of a nation's historical destiny. In Vietnam, the corresponding governmental message was equally authoritative, powerful, and deeply resonant. Officials hailed the reinstatement as the definitive rise of a strong and prosperous Vietnam. Citizens were strongly advised to maintain calm, conduct exchanges in a gradual manner, and maintain absolute trust in the official controlled process. The government guaranteed complete financial transparency, stability, and fairness for all. As full daylight spread across Asia, the entire world witnessed a nation confidently stepping into a new era of financial self-determination. The deeply emotional scenes broadcast from Hanoi showed quiet, immense pride, emotional hugs, and tears of joy, the specific kind of profound satisfaction that results only from decades of patient endurance finally yielding its reward. Across all major international news organizations, analysts fiercely debated the implications for the future. Could other emerging market currencies potentially follow this path? Will this single massive event trigger a widespread forex realignment that fundamentally changes global trade and investment strategies? Many leading financial figures believe this is only the very first tentative move in a coordinated chain of global economic resets designed to rebalance world power away from its current concentration. For the immediate future, all clear indicators point to one inevitable conclusion. The undisputed global dominance of the US dollar is now facing its first legitimate, significant challenge in generations. The map of global finance is actively and rapidly being redrawn. Inside the world's most powerful trading companies, software engineers continued working nonstop, urgently updating complex algorithms and recalibrating specialized trading bots. Every single computer system designed to process forex pairs had to be fundamentally rewritten to successfully incorporate the new VND and IQD data streams. It was an enormous logistical undertaking, but it also served as irrefutable evidence of how deeply and permanently the change had taken root. What was once dismissed as a mere theory, whispered only in fringe online communities, has now become the single largest global financial system update since the official introduction of the euro currency. As the hours of Saturday, November 8, 2025 progressed, the volatile markets gradually began to stabilize. The dinar firmly maintained its new, strong position above the $3 per US dollar equivalent, and the dong held its strength consistently. Central banks continued their silent coordination, and governments issued carefully worded, measured statements. The initial burst of chaos slowly subsided, but the core financial impact remained absolute and irreversible. The world has undeniably witnessed the emergence of a new financial reality, one that provides clear proof that unwavering belief and disciplined persistence can ultimately rewrite even the most rigid, entrenched economic rules. Now, as the dawn breaks over Baghdad and Hanoi on Sunday, November 9, 2025, millions of people are waking up to a radically new world, a world where two nations, long underestimated and marginalized, have confidently stepped into the global financial spotlight. A world where a nation's true value, once purposefully obscured by conflict and years of speculation, has finally been recognized and affirmed. For a vast number of people, this is far more than just an economic victory. It is a powerful symbol of hope and tangible proof that history is indeed capable of delivering the unexpected. The VND and IQD are back. The Forex reset has officially begun, and the world will be permanently changed. This financial cascade continues to build momentum, confirming that the initial Forex resynchronization was merely the beginning of a larger, coordinated plan. The situation surrounding the Iraqi Dinar IQD has moved completely from speculation to verifiable execution, backed by the highest levels of government and now confirmed by internal U.S. banking protocols. A highly confidential, leaked internal memorandum from Chase Bank, a Tier 1 U.S. financial institution, has now provided irrefutable evidence that U.S. banks are actively preparing their systems for a shift in the IQD's status. The memo, intended for a restricted group of currency staff and branch managers, was titled, Upcoming Adjustments, Foreign Currency Revaluation Monitoring. The memo specifically lists the IQD as a currency requiring immediate monitoring for upcoming changes in exchange rate visibility. This is the key. When a bank like Chase mandates this level of internal preparation, it signifies they have received upstream data from international financial channels, IMF, CBI, U.S. Treasury, and are configuring their infrastructure to display new, higher figures not yet public. This completely reverses the historical institutional policy of ignoring the dinar, proving that the IQD is no longer a fringe asset but one being actively tested for full visibility and trading. The entire complex sequence of the Iraqi Dinar's IQD Revaluation is currently transitioning from a phase of high-level compliance and political declaration into a highly intricate, multi-stage operational execution governed by the Central Bank of Iraq, CBI, and coordinated with global financial institutions. The recent confirmation of an institutional-level contract exchange rate system signifies the final, delicate prelude before the public announcement, a process built upon a carefully structured, two-pronged approach that utilizes a dual rate system as a necessary bridge to a single, much higher sovereign rate. This approach is historically common in successful currency reforms by commodity-rich nations seeking to reclaim financial control and prevent the destabilization that an immediate, sharp change in the public rate would cause. The first critical prong of this final execution phase is the controlled ascent via the dual rate mechanism, often referred to in macroeconomic texts as a period of exchange rate unification. In this model, the CBI maintains the low legacy public rate for most day-to-day citizen transactions, specifically to manage immediate inflation and shield domestic commerce from the initial shock. Simultaneously, it actively operates the new contract rate for all strategic, high-volume, and external transactions, most importantly, oil exports, Iraq's primary source of foreign exchange earnings. By valuing its oil revenue, which represents over 90% of its national income, at the new higher rate, the CBI instantly multiplies the actual wealth entering its national treasury and significantly strengthens its balance sheet, providing a stable foundation to back the new currency value. This strategic use of a higher controlled rate internally acts as an essential firewall, allowing the new economic reality to be established and stabilized at the institutional level without immediately triggering massive capital inflow or panic selling at the street level. The second and most visible prong involves a sequence of monetary policy and technical unification steps that the CBI must meticulously complete before the final public rate announcement. The most immediate technical step following the contract rate activation is the systematic incremental reduction of the legacy public rate's exchange rate support. The CBI will progressively reduce the volume of U.S. dollars it sells to commercial banks at the old, lower rate, forcing more commercial and capital account transactions to migrate to the higher, de facto market rate that is now anchored by the successful contract rate. This maneuver naturally causes the parallel street rate to converge upwards toward the higher institutional rate, effectively shrinking the historical and destabilizing gap between the official and black market values, which has been a primary demand of the IMF. Concurrently, the CBI must re-index its entire monetary policy framework around the new higher rate. This involves aggressive interest rate adjustments to attract foreign capital and support the newly appreciated dinar, a move essential for defending the revalued rate post-launch. Furthermore, the digital and structural integration of the banking sector, already confirmed by Prime Minister Sudani, must be finalized, ensuring all commercial banks are fully compliant with international anti-money laundering, ML, and counter-financing of terrorism CFT protocols as they process the immense volume of foreign currency conversions, the Forex resynchronization that will accompany the rate change. The final act of this extensive operational sequence is the public rate unification and announcement, which is often accompanied by an explicit televised statement by both the Prime Minister and the Governor of the CBI, giving the move the full weight of the sovereign government. This announcement involves unifying the dual rates into one official rate, the new sovereign exchange rate, which is set either at the proven level of the old contract rate or, depending on the success of the capital controls and foreign reserve accumulation, a slightly higher peg. This new rate must be immediately visible and actionable across all major international financial systems, which is the exact reason for the leaked Chase Bank memo's instruction to adjust for exchange rate visibility. For the public, this is when the removal of the 3 zeros, a redenomination, may be introduced, simplifying the new currency's denomination for domestic use by making the new dinar equivalent in value to the former 3-0 removed amount, thus signifying the final break from the currency's low-value history. The Prime Minister's timeline targeting activation before the new fiscal year in January 2026 provides the crucial outer bound for this entire, final operational phase, reinforcing the urgency and coordination currently observed at every level of the Iraqi and international financial infrastructure.